Getting close to retirement is an exciting time, but it can also be a stressful time, especially if you're seeing changes to your portfolio in a negative way. 10 years ago, the market fluctuations may have been really easier to stomach because we knew that we had time on our side and you were continually adding to your savings. But now that you're getting closer to actually having to use those retirement savings, little dips in the market can start to feel like massive craters now. But just so you know, that's a normal feeling. Having helped hundreds of people retire, we've seen that it can look really a lot like this here, where as you're leading up to retirement, you start to notice that stress levels around money and planning increase, and then stay that way for a little bit afterwards until you kind of fall into a groove. Not everyone feels this way, but it's not uncommon. But there are ways to lower your worry or stress at this point in your life, right at that retirement date point, and I'll share that with you in this video. I'm Dave, and I run Streamline Financial, a retirement planning firm with Tim and Luke and Sean, and we get to meet with and help a lot of people nearing retirement and already retired. If you're interested in making your retirement just a little bit better each week, check out the 5-minute retirement link below this video. So on to that important thing to do to get to that level 10 confidence with your retirement plan. Just remember, it's actually not a one and done solution. Although a lot of people set it and forget it, it should really be something that you check in on every so often. And that is to check to make sure that your asset allocation is in line with your income plan. Now you may be thinking, what does that mean? Or how do I do that? Or yeah, I've heard that before, I know this already. So if you're thinking one of those things, hang tight, because I'll give you a free and easy way to check your asset allocation pretty quickly. And then I'll share a trap that some people fall into when they're doing this, where they think they're all good, but really they are not. To make sure that we're just on the same page here, asset allocation at a really high level is really just how you spread your money across different asset classes like stocks, bonds, and cash. And then as you dive into each one of those categories, let's say stock funds, you get a little deeper and then you see that there's US stocks or international, emerging markets, or large, small, and mid cap. And then when you look at bonds, there's long-term, intermediate, short-term, high quality or high yield, corporate or government, or US or foreign. And there's also other asset classes that are different than stocks, bonds, and cash, like real estate, commodities, and then some would even say that cryptocurrencies or Bitcoin is an asset class now. But the trap that I see some retirees fall into is keeping their allocation too general. What I mean by that is that they can check the box of having a diversified allocation across many asset classes, but it's because they're in a few target date funds or they're in a 4-fund solution from one of the big firms out there. In my opinion, this can work for a lot of people, but for many who want to have more control over their income plan, or they just want more control over the investment strategies that are available to them, or really more control over when they pay tax or how much tax they pay, they might be better served, for those people who want control, might be better served not using those all-in-one fund solutions, and instead split their holdings into specific funds that are tied to those different asset classes out there. If this is sounding like gibberish right now, hang on, I think I'll be able to clear it up, and then we'll get into that easy to use tool to help clear it up for you as well. Let's just pretend that you had a balanced fund, one balanced fund that's diversified among many different holdings. Here's the description actually that I pulled up, and if we look at it, let me get to the page, we'll see that here's the description. This index fund offers investors easy, low-cost way to gain exposures to stocks and bonds, roughly 60% in stocks, 40% in bonds by tracking 2 indexes. And so when you look at that, it sounds pretty good. If my plan called for a 60-40 portfolio that's in line with the actual income plan and my risk tolerance, it seems like an option that provides diversification, because there is these asset classes that we're talking about over here, stocks and bonds and different kinds, and then it seems to be weighted in different ways to make up a 60-40 portfolio. And again, in my opinion, this could work for many people. And just as a reminder, this is not advice, it's just a hypothetical scenario. But for those who are looking for more control over their income plan and investment strategies, things like tax loss harvesting, where you can potentially lower your taxes each year, or trigger-based rebalancing, they might find that it's better not to have this general type fund, but instead get more specific in their asset allocation strategy. And here's an example of what I mean. If there's a time of the year where, say, small cap stocks go down a lot more than large cap stocks, there may be a tax loss harvest opportunity to actually lower your tax bill that year. If you're in a target date fund or a 1-fund solution or maybe 4-fund solution, you're not able to single out that small cap portion to take advantage of that strategy. Or say that there's a year where large cap growth does really well, and then it starts to take up a bigger piece of the pie because it's growing faster than everything else. That fund may be rebalanced where they actually sell some of that gain, and then you recognize the gain even though you didn't sell the actual fund. It's just happening within the fund. But having a more specific allocation strategy will actually allow you to decide when you want to rebalance or when you want to pay tax or tax loss harvest. One final example is when it comes to the income plan. Let's say that you need to take a withdrawal for income and it's a bad market period where the fund is actually down. The stock portion within this one fund may be down and the bond portion may actually be flat or up. It would be nice if you'd be able to just use that bond portion or whatever the conservative portion is and not sell the stocks that were down. But that's not in control if you only have one or a few fund solution. So hopefully these examples give you just an idea of why more control over asset allocation could make sense and could be important. I know that it is for our clients. Now let's look at that free tool to get an idea of where you are currently, what your asset allocation is. The first step is you're going to need your statements or at least the names or ticker symbols of the investments that you have in your different accounts. Then you're going to go to portfoliovisualizer.com. I'll include a link below to this tool and then plug your investments down here in this asset section. And I'd say it's worth taking each account separately, just meaning if you've got pre-tax monies like IRA, 401k or 403b, I would say plug those in here and then look at that allocation and then do the same for your Roth accounts and then do the same for your non-retirement brokerage accounts because each one of those is treated differently tax-wise, and the holdings that you have, there's this thing called asset location as well that can be important. So here's an example. Again, none of this is advice or recommendations. I just took a few Vanguard funds and weighted them pretty equally, and this is a balance fund, total stock, bond fund, and then the short-term inflation, and then just cash, and with weightings here. So again, not recommendations, just examples. Then you'll click Analyze, Portfolio, and then you'll come up with a few different tabs up here to take a look at. Now you may be thinking, what do I do with this info? There's a lot here, and how do I make sure it's aligned with my income plan? So here's a few numbers to look at. You can start off, sure, you could look at what your allocation has done the last few years. And then in exposures, you could see that what we looked at earlier with these different, across different style categories. And then a few other helpful things if interested, just expense ratios. That's always good to track and be aware of. And then here's allocation in pie chart form. And then up here, there's a few others. Annual returns could be interesting to see each one of the asset or each one of the funds that you had input here and what they did the last few years. And then there's this one called assets, which gives you an idea of what sort of risk you're taking on in each one of these accounts. There's other numbers here that get a little bit complicated, but here's just an example of best year, worst year. You can kind of see the short-term inflation and bond funds and cash. They don't have as big a swings as the, say, balance fund or total stock index fund would have, but it just gives you an idea. Also this max drawdown from peak to trough. What's the largest drop that they've seen? And if interested, you can kind of get a year to date or just a few different years to see what these funds have done in the past. And by the way, I know that a lot of going through this stuff, it can still just be overwhelming. And I know that a lot of people in retirement, they want to use their time the way that they want to. And if you have no interest in spending your time learning everything that goes into successful retirement planning, click on the link to have a call with me. We don't always have availability, but you'll definitely hear from us either way. Now back to how this asset allocation relates to your income plan. Look back at those, see if you can identify some of the conservative funds or ones that have historically been in the conservative bucket, if you will. I'm just looking at these two here, worst years and max drawdowns. Maybe think about adding up the balance of those conservative bucket funds. And then next, take how much you need in income that you're pulling from your investments each year, or think that you might be pulling from investments. And then see how many years of withdrawals do you have in that conservative bucket. After you do that, ask yourself, am I comfortable with this? Am I comfortable when I'm looking at the overall allocation? Am I comfortable with that? Am I diversified among the different asset classes? And then am I weighted too much in stocks, or maybe I'm too much in bonds or cash? Because we know there's different types of risk. Yes, there's market risk. There's also inflation risk out there. So it's not always easy, but hopefully this gives you an idea and a tool to maybe play around with and get an idea of what you're currently doing. To sum it up, the one and only step is do a review of your current allocation, maybe use this tool or another one that you've heard of. If you haven't combined your income plan and investment plan to be working in tandem, stay subscribed so that I can continue to share ways to do that, or find an advisor who can do that for you, who specializes in retirement planning. And then you can always reach out if you have questions. But have a great rest of your day and take care.